Momentum. Today, we're gonna piss off a few people, but most importantly, we're gonna inspire so many others to challenge everything they heard. Now, momentum is beautiful because you can see it on the chart, it makes sense, and also it snowballs. If something goes up, everyone chases in and it just push the price up, which is what we love and see. But is it good? Does it make sense for the investor? We're here to find out. Today, we're gonna challenge this book. Now, this book, mind you, I love this book. This is the first book I read when I shifted from trading, which never worked for me, into stocks. And Momentum gave me the chance to think about how to approach the market, and it really did make sense because the way they presented into this book is extremely compelling, but I never really stopped to actually challenge it. So today, we're gonna look into this book, we're gonna challenge what the assumptions are, and we're gonna see if we can trust everything you read in a book. I'm Alberto, and I help people and businesses alike to find the best investment strategy for their own situation. I do that with research backtest and, of course, a little bit of my own experience. So if you are ready to Jindex, welcome to Jasper's Door. So momentum, are we following the hype? First of all, I like to say that this book is great. It's very, very well written, and the people behind it, they are trustworthy. So we're gonna treat it with respect, and then we're gonna assume good faith on their side, as they did the best they can to prove that what they said is actually true. So whatever comes up today is not to point them out, is actually because we like to challenge everything. We do not take anything from granted. Now, what is momentum? Momentum is simply the movement of a price stock up or down. They both are considered momentum. And in this particular setup, what we also would like to see is not just the movement, but also the consistency of that movement over time. So the more volatile price is, the less quality that momentum has. Right. For example, the stock on the left has kind of a more volatile approach, where the one on the right is a little bit less volatile, more consistent over time. So in an investment situation, we would probably prefer the one on the right. Now, to simplify that much more and to make sure everyone is on the same page, yellow line, very volatile. We don't like it, although it has the same returns of the gray line, which is very consistent. It grows consistently. We like that. Now, before we go any further, I would like to add my own experience to this. I have been a big trend follower back then when I was a trader. And again, trading never really did work for me, but I brought that experience over into stocks. So when I started in stocks, I did love this book. It was actually great insights, but also when I actually start testing my own strategies, when I actually start chasing the returns into the data, I never actually found a way to make it consistent. And so that's where I'm coming from. That's my own bias there, and I'm aware of it. But also it's a little bit of a challenge to make sure that you stay unbiased when all my experience, and we're talking about years now, is telling me that momentum is not the strongest of the factors out there. And that's probably an euphemism too. So that's where I'm coming from. The book defines momentum has high recent returns with low volatility. That's the definition of quality for them. And that is supposed to have high expected returns as per the whole book, pretty much. The research they provide, it's quite compelling. And to be fair, they come up with 17 to 20% return yearly, obviously, with a 25% volatility. Now, both the volatility and the returns are very high, so you get very good returns. And they also bring that volatility that is not everyone's favorite cup of tea. because when you're in the moment and you get a 20%, 25% standard deviation, that means every year you expect 67% probability that you're gonna lose 25%. It's a lot. It's definitely a lot to withstand every year. So this is the portfolio they built. So the data we are coming up against is what we're seeing on the screen right now: mid and large caps. Obviously, the top momentum performer with low volatility. That's what they say they use. And there's a look back of 12 months, excluding the last month. Now, excluding the last month apparently will protect you from drawdowns. And maybe the stock had a very bad last month, but because of the strength of the momentum for the last year, they say that even if they had a very bad last month, it is exactly where you want to be, because the momentum will push back the price higher. They're pretty much chasing corrections in price. They're gonna hold 50 stocks, and they were gonna hold it until the system tells them not to have them in their portfolio anymore. Something else will come up with better momentum and update. Now, that last bit is a little bit off to me, because in order not to have good momentum, you need to lose in price. So pretty much in order to get kicked out from the portfolio, you need to have a bet. Or either any other stocks get better and better and faster in their momentum, or the stocks that you have in your momentum will have to drop in price in order to stop the momentum from being that good and therefore get out of your portfolio. Just a thought I had there. This is pretty much how they calculate momentum. The price 1 year ago and minus the price of 1 month ago. That's the raw growth they use. And for the volatility, they use standard deviation. So again, the gray line would have a better standard deviation or a lower standard deviation compared to the yellow line. And what their definition is of quality momentum is very closely related to Sharpe ratio. Sharpe ratio is a little bit more complex. It has an extra variable in it, but for the sake of this video, we're gonna just stick with gross versus standard deviation. And that is what we're gonna call Sharpe ratio in this video, just for the simplicity of it. Now, I built my own calculation for this, and this is the results, just to confirm that the calculation are correct. So this is an example of low Sharpe ratio. You can see, again, please remind that the last month is not considered when it comes to returns. So you will see the returns to be aligned with the last year, but removing the last month. That's what they do. That's what we follow and we do as well. So Sharpe ratio is minus 0.73, which is a very, very negative Sharpe ratio. Anything above 1 is of strong significance. Having more than 1 is definitely what you want in your investment portfolio overall. Now, because these are single stocks, the volatility is very high, but also the returns can be very high. So we kind of expect a linear correlation in between the Sharpe ratio and the overall results and returns of our portfolio. So high Sharpe ratio should correlate with high performance, and low Sharpe ratio should correlate with low performance. So the Jindex we're going to use to set this all up and test it is this. So we're going to use a universe of global stocks. Remember, the book used US only, but the rationale behind it is that if this is an investable factor, you must have that factor to be true across the planet. It cannot be only one market. It just needs to be robust enough and spread enough to be true across the planet. This is very important if you want to trust your portfolio. Select 50 random stock from the decile. So we're going to take those decile, all 10 of them, and pick 50 random stocks from there. And what that builds is a random portfolio, but with company with the same kind of momentum. And we're going to repeat that 5 times for each decile to make sure there's no outliers, and that we can use the median of those 5 in order to be sure that the results are kind of indicative of what kind of momentum we expect from in each decile. And we're going to rebalance every 6 months just because it makes it easy peasy, and also it just makes the portfolio consistent. To run the experiment, I'm going to use Morningstar data, and again, you can see the code in the description. There's a link in the description that brings you to the code. If you want to replicate this experiment, you can totally 100% do it. So if you're ready, you're going to see a random portfolio, and that is something that I use in all my videos in order to make sure that the factor that we use is actually beating the random. So the baseline, you need to be better than random in order to have a factor, right? Also, we're going to see the top percentile, so the 10th percentile, which is what we expect to win with momentum being a factor, and also the first percentile. The first percentile is obviously the worst. We expect that to be the least performing in this. And also I added the third and sixth just to have some comparison in between, and also to have some indication of where we should be sitting at. Now again, this is from 2000 to 2025, and here we go. Did you see it? You want to see it again? And what we're seeing here is actually kind of concerning. First of all, random beats everything else, which makes momentum consistently not good. This is unrelated from the day. Any decile is underperforming random, which is kind of weird. And also, first and 10th, they are both together at the bottom of it. So you can get the worst and the best momentum stocks, and they're sitting at the bottom. Again, we're running this on Morningstar data. There's no cheating. You can replicate this experiment at home by using the code in the link in the description. But you can see there's nothing that makes momentum a factor there. Like, you can get random stocks and you will get better results. Let me show you in a different form. Now, again, look at the bottom. The 10th decile is on the right and the first decile is on the left. Again, the best momentum, the highest quality momentum is on the right, where the red side is, and the lowest momentum are on the left. But if you look at the line, this is returns over time. This is annualized returns over time. You can look at the line and you see that both left and right, both low quality and high quality momentums, they don't have anything to show for. In fact, they're underperforming everything else, which is in the middle. That's where the highest performance are. Mind you, again, even the highest performance in this chart is not outperforming a random chart, a random portfolio. And what that means for us is like, what should I take away from this? There's nothing there, right? You can see how the volatility drops to 15%, which is very low for a portfolio, around 7th to 9th, and that's kind of consistent there. And what that tells me is this, right? It's not the momentum that pushes the results in there, is actually the quality factor that is implicit in our calculation. So the low volatility factor is actually in there pushing, but as long as you use high momentum, you're gonna have the market revert on you and go back to the mean, and therefore underperforming. So maybe the takeaway from all of this is that we should look into the low volatility that brings that middle ground up instead of what momentum is. Now, In the future videos, we're gonna probably check different ways to approach momentum just to make sure that we didn't miss anything. But for now, that we're gonna compare what the book said and also to what we found, there's nothing there. Like, not just there's nothing there, but like you cannot really, like, one takeaway from this is that you cannot really trust even books now. And I don't know, man. It's kind of confusing because I always been on books for my whole life in order to learn stuff. I did not trust YouTube as much, but books, I always thought if you write a book, you know what you're talking about. Anyway, from us, we find that mean reversion in the extreme is gonna be punishing for our portfolio, so that's not good. We don't want to have both very high momentum or very low. That's something we're gonna bring up in our portfolios. And also, momentum is not a pure factor here. Maybe there's something in the volatility factor that brings momentum up. And we know that there are some ETFs based on low volatility doing extremely well. But also, what we take from here is that momentum is not really a factor, at least in the way this book did it. We're going to consider that busted. Not today, Mr. Vogel. We're going to put that in the Jindex leaderboard. So in the next video, we're going to talk about something we came to love, and that is value. Now, value is something that can be done in different ways. So we're going to start with a good benchmark. And that is the way that Morningstar does it. Everything will be clear in the next video. At the moment, jump on jasper.com/leaderboard to see every other way to invest that we are tested so far. For now, me and you, what we're going to take away from this is that momentum, I don't think, is actually a factor. And maybe in the future, we're going to dive into low volatility stocks and see if there's some merits there. For now, I am Alberto, and you are on Jasper's Door.